If your money is just sitting in the bank, this episode might change how you think about your future.
We are going to show you step by step how investing really works, starting at the very beginning.
Hi, friends. I'm Nancy Fox.
And I'm Elaine Duran. Our guest today is Dr. Alan Fox.
Now, Alan graduated from UCLA in physics and earned his doctorate in psychology also at UCLA. We shared him in the past shows and that he had a background playing professional tennis. And now, after grad school, he spent years in the investment business, ultimately running his multi-million-dollar investment company.
Which is exactly why we thought he'd be perfect to teach all of us about investing in the stock market. He's user-friendly, and he makes things really simple.
Let's dive in.
Hey there, friends, it's Nancy and Elaine. They're the deep diving divas, it's quite a name. They're diving deep into the things that matter most, from friendships to family and so much more. Join them each week for a splash of fun.
Hi, Dr. Fox. I know you. Welcome back to Deep Diving Divas.
And Elaine, you know him because guess what, everybody? If you haven't seen our first couple episodes with Dr. Fox, he's my sweetheart. He's my amazing, brilliant husband of 45 years. So, Alan, let's start right at the beginning. You had such a wild story about how you got started in the investment business. And I thought briefly it'd be really fun for you to share that story.
Well, I got my doctorate at UCLA in 1968, I think, and I was going to go to work ultimately as a research scientist. And so I started interviewing firms, and I think I got an offer from one for $1,000 a month.
Wow.
Yeah, so I thought that was pretty good. And then the more I thought about it, the more I thought I might as well if it's money I want. And I found I was looking at the salary more than whether I was going to do research. Why don't I just go into the investment business, which is where all the money is? By this time, I had finished my tennis career, and it was in the early 70s. And so I started interviewing stock brokerage firms in Los Angeles. And one of them gave me a call back. I got a call from a lady, and she said she was a secretary at Kleiner Bell and Company, which at the time, that was one of the hottest firms on Wall Street. They had offices in New York and in Beverly Hills, and they were doing all these big merger deals and acquiring companies and so forth. And the head of it, a guy named Bert Kleiner, was on the cover of Fortune magazine. He was a big name in finance. And so I get this call from the secretary saying, Mr. Kleiner would like to meet with you. I go, wow. Why?
Why me?
I just need to be a broker and sell stock and collect commissions. I didn't know anything. And by the way, I didn't know anything about business at all. I had been a scientist and a tennis player my whole life. And now I had to make a living. And so where the money was.
Briefly tell us why he hired you.
So I went and interviewed Mr. Kleiner, and he said, I'm looking for an assistant. He says, somebody that would sit in my office and travel with me and help out. I said, Mr. Kleiner, I hate to tell you this, but I have no experience in any of that. He didn't know how little experience I had. At the time, I didn't know what a stock was.
So, Alan, tell us, what is a stock when you say that? Because so many people don't know what it is.
Okay. A stock is a part of a company. It's your small percentage ownership in a company. That's all a stock is. And so a company, when a company is incorporated, it creates a number of shares of stock. Okay, and so if a company declares 1,000 shares of stock, and you own 1 share of stock, you own 1,000th of the company. That's all it means. If you own 50 shares of stock, you own 50,000, whatever that is, of the company. And so, as a shareholder and owner of the company, you have a right to that much of their earnings. And if they sell the company, you have that percentage of the proceeds of the sale go to you. So that's why you want to know what the company does. For example, if you were going to go buy the neighborhood drugstore, okay, someone offered you 50% of the drugstore, they say, okay, and they want $10,000 for it. What would you ask them? The first thing.
Oh, right. Yes, go on.
That was a rhetorical question.
Oh, okay. So,
I was planning to answer it myself. I don't know what to do that. God knows. But what most reasonable people would ask is, how much money does it earn? Right? That's what you'd like to know. If you're going to spend $10,000 and own half of it, half of what? You know, when you own part of a company as a stockholder, it really doesn't matter 100% how they make their money. What you're interested in as a distant owner of this company is, how much money do they make? That's it. You don't care how or what. Okay, so that's when you buy a stock, you're buying into the company. Now, you're not buying 50% of it, you're buying 1 billionth of it on the big companies. But nonetheless, that one share is some small percentage ownership in that company, and the stock price will go up and down based on how the company does in terms of earnings. Okay, so what you want to know if you're going to buy a stock is, what is the earnings of that company? Okay.
and
And
can I just ask you a question then? The earnings for the last month, for the last 3 months?
for the last year, and the prospective earnings for the coming year. The most important earnings are the ones that are coming up, because past earnings are only interesting to you in that they give you an indication of how much money they may earn in the years you own the company. I mean, in the past, you don't get any of those earnings. You didn't own the stock at the time.
Right.
So owning the stock, the stock market is an auction. Okay. It's an auction where the stock is put up for auction, and a bunch of people want to buy it, and a bunch of people want to sell it at any instant. So it's this auction, and if there are more buyers than sellers, the stock price goes up. If there are more sellers than buyers, it goes down. And if the company's earning a lot more money, and the earnings have been going up and it looks good, there will be more buyers, and that will drive the stock price up. Okay, so you're very interested in the earnings and what the future earnings might be.
That
Okay?
makes sense.
That
Really?
that controls, ultimately it controls the price. at any instant, it doesn't control the price because there are a lot of other factors that make stocks go up and down. But in the long run, it's earnings. Okay.
Let me ask you something. I know you do all your own research and you're looking probably every day. When somebody has a stockbroker and really they're not following it themselves, don't they kind of run the risk that they have to kind of trust that stockbroker to be making the right decision, or because if you don't look at it every day, but you are looking at it.
Yeah, I do look at it, but here's some advice for somebody that's not prepared to look at it every day and research everything themselves. They shouldn't be buying individual stocks. It's dangerous. And your stockbroker, that's not a good reason to buy a stock because your stockbroker says it's a hot stock, buy it. If you're not sophisticated financially, the best way to own stocks is in a mutual fund where you have a paid manager that buys and sells the companies that are in the mutual fund. You know how mutual funds work?
Well, explain to us. Explain.
A stock brokerage firm will create a mutual fund, and what they'll do is they'll raise money from a bunch of their clients and put it into a basket, and they'll hire some very smart guy who's got some big reputation to take control of the basket and decide which companies to buy and which companies to sell. Okay. And so this basket of companies, basket of stocks, basically, is controlled by a manager who's a lot smarter than we are. And so that's who you want buying and selling companies on the stock exchange for you. You want a manager because amateurs, it's that is somewhat, I shouldn't say risky.
That is so helpful because I know we have mutual, funds, it's not funds, it's mutual funds.
Mm-hmm.
You're explaining it so in such simple, summarized, that it's like, wow, I always know that's what Richard's talking about, but I didn't know that's what it was. And the whole basket theory really makes so much sense.
Explain the baskets, some of them that we're in.
There are 1,000 mutual funds of various kinds. Okay. And the manager or managers will have expertise in one thing or another. Okay. And so the mutual fund will specialize in certain areas. For instance, the ones I like are involved in real estate. I'm actually getting off to the side because most people think real estate is very safe. You own an apartment building or something and you manage it, and it doesn't go up and down every day like the stock market. Okay. But you can buy real estate on the stock market. You can buy a mutual fund where the management of this fund goes out and buys real estate, and you get all the earnings from that real estate. At the end of every month or quarter, they'll pay you dividends of the earnings of that real estate. And so you can own real estate with stock, but you don't have to manage it. You have a professional manager that's managing your real estate for you. And so that's the way we own real estate.
Yeah.
It's called the Real Estate Investment Trust. Okay.
Interesting. I'm going to write that down.
People that we hear that are afraid to invest in the stock market or afraid of the stock market in general is because they think it's incredibly risky. And so what does risk actually mean when you're investing in the stock market or a particular stock?
What you try to do with any investment is to get the most return for the least risk. Okay. But let's identify risk just to start with. In financial terms, there's no escape from risk. Okay. No matter what you do, you're at risk. For instance, you put your money in the bank. Well, you're at risk of inflation. Okay. The government will devalue your money while it sits there. It's the value is leaking out the back, and you think it's safe just because you get the same amount of money back, but it's not. The money's not worth as much, and ultimately, the only reason to have money is to buy things, and so you can't buy as much for $1 as you could 10 years ago, and certainly not 50 years ago. So you you have risk no matter what you do, but in the investment business, the least risk you can get would be to buy government bonds. Okay. And for government bonds, you get maybe a little under 4% for your money. That's the return, essentially no risk return financially. Okay. There's a relationship between risk and return, however. In other words, the more return you want, the bigger risk you have to take. Okay. And so there's all kinds of investments. But if somebody tells you they can get you 10% on your money at no risk, they're lying.
Run.
Yeah. Okay.
Yeah. Well, let me ask you, Ellen, for people my age, I guess all of your age, Nancy's age, I mean, are we too old to be investing at this point? If you hadn't invested before, I mean, should you be just doing safe, or I guess you want to take something that has less of a risk? But what age would you say, is it ever too late, is what I'm trying to say, to invest?
If you're going to be dead in a year, probably should keep it.
Make it liquid.
We don't think we're going to live indefinitely.
No.
Yeah, if we're going to live forever and we are all of our ages, what is it too late if they're hearing our show? They're saying, I might want to look into investing. Is it ever too late?
You don't, if you need the money within a year or two, you can keep a lot of it in cash because the stock market does go up and down. But here's the deal with the stock market. Long term, the odds are tremendously in your favor to make money. Okay. And here's why. The stock market is essentially a conglomeration of all the companies in the country that are public. Okay. And you own pieces of all these companies, or you can. Okay. In each of these companies, they have management teams, and their job is to make you more money. Okay. As an owner, their objective, the objective of the CEO of all these major companies and everyone down the line is to make more money, because when the company earns more money, the stock price goes up. And so they all are tied in with options and so forth. So they make more money and they get raises and they make money. And so you have the accumulated intelligence of everybody in the business community working for you. So 10 years from now, if you look at all the companies 10 or 20 years ago, they didn't make as much money as they do now. They've all made, or almost all made, more money. Okay. So you're jumping into a river that's going in the direction you want it to go, which is up. And so, especially if you own mutual funds, you you've got a basket of companies. So if one of them doesn't do well, it won't hurt you. You've got many others that will. See, and you've got the odds working for you, but they don't work instantaneously. I mean, unless you're awfully lucky. I mean, you put your money in, it's not going to earn a lot more money tomorrow. It'll go up and down. But over a period of time, baskets of stocks run by solid people go up.
At this point, I know there's a lot of people out there that are saying, Kai, I never really knew this information. I am in the stock market, but I use a stockbroker or a money manager. And so in simple terms, is that always the best way to go? Because they do take some kind of percentage. And maybe you can explain to us without judgment, because, hey, we're not here to talk people out of working with their, management companies. But what are these people earning? Why are you paying them a percentage? And what does the percentage look like?
Okay. Well, most money managers, if you go to the big, you go to Fidelity or you go to Schwab, they have money managers, and they will manage your money for you, depending on how much you give them. They'll charge you a smaller percentage if you put in larger amounts. But for normal amounts, it's going to be about 1%. For small amounts, it'll be 1.5%, maybe. For large amounts, it might be 0.75%. But realize that and here's what you should expect to make with your stock market investment over time. You would expect to make 8%. That's about what the market has done over many, many years. If you were in the market in some substantial way over a period of time, you could expect to make 7, 8, maybe 9% if you're lucky. But that's the kind of percent. So if you're expecting to make 7 or 8% and they take 1%, okay, that's 20% of it. Well, not quite that, 18% or 15% of your total income.
That's a
is
lot.
going to that manager.
Yeah.
Now you want to know what you're getting for it.
Right.
You can do it yourself if you're just slightly knowledgeable. You don't have to be too smart, because you can go to Fidelity or to Schwab, and they have all kinds of mutual funds that are managed professionally, and you can buy in on them. You can buy it on technology fund, or you can buy it on a heavy machinery fund, or anything you like. There's funds of all kinds. And now what happens with money managers is they'll take 1%, and then they'll put your money in one of these funds. Wait a second. You could do that yourself.
Is that their salary? I mean, is that how they earn their money by this 1%, or are they actually paid by, if you're going to Schwab?
The 1%, they make their money by how much money they have under management. They make a percentage of that. And so, but then they invest your money, and often they'll put it into funds. Well, now you pay another manager in the fund. He takes a fee too for picking the stock, the individual stock. So this guy takes a fee for picking the fund, and the fund manager takes a fee for picking the stock. And so you pay 2 fees.
Let's just finish this conversation. The difference is if someone is with their money manager, stockbroker, they're happy, but there's knowledge, there's strength or power in knowledge. That's how I've always looked at everything in life. And this is what it's about. And so let's say they have $500 to start. Can you open up a Schwab or a Fidelity account with as little as $500?
You can open it up with $50. I mean, both Schwab and Fidelity, which we have money with, they're big and they're very easy to deal with. You can do it on your computer and you can buy things with very little cost. It's very efficient. And they have money markets, both of them. In other words, if you have spare cash, you open your account. In Fidelity, it goes directly into the money market if you open the account, put money into it, okay, and you get immediately 3 3/4% interest on it, every day. Okay.
That's
Schwab
before
has-
they even start, Alan, that's even before they start you start investing the money, right? It's just sitting in that account versus the bank. That gives you about
Right.
1%.
It's called your core account, and you get a little under 4%. Schwab has the same, although you have to put it in the money market, but it just takes one keystroke on your computer, and it's in the money market. So both of them are very, very efficient, and they have people that will help you. They'll tell you what I'm telling you, probably. Similar.
Well, let me ask you, just kind of being the devil's advocate, why isn't it just safer to put your money in a CD account that some of them are making 4%, 5, maybe now 5%? I don't know.
CDs tie your money. In the money market, you can put it in and take it out daily. Take it out whenever you want it. With a CD, you're limited. They're in for a particular amount of time. But they're not paying 5% these days.
Right. More like 4.
They're paying under 4%. It all goes down to the government bonds yielding about 4%. Okay, that's the, what do you call it, benchmark, I suppose. Well, the kind of financial information I'm talking about should be in the schools so that young people understand this very basic, simple stuff, because most people don't have any idea what a stock is or why they should invest or how or anything. They find out piecemeal later.
All right, Alan, we're going to have to stop here, but clearly we have so many more questions for you, so many more questions I know you out there have. So we need you to come back. We're going to have to do a part 2. We'll do another one. We'll stick with that. So everybody out there, I hope you got some good information and sort of a start, and we're going to welcome your questions. But if someone wants to find you to buy a book on one of the mental side of tennis, or read some of your articles on tennis, they can find you at alanfoxtennis.com. Thank you, honey. We're gonna pick your brain some more.
Hey, Alan, I've known you probably about 30 years. I wish I would have known you about 50 years ago. Before I became a teacher and didn't know how to save. Would have been good.
Yeah, you'd be a rich lady now.
Yeah.
Thank you, sweetie.
Great.
Everybody
Thanks.
stay tuned. Elaine and I will be right back.
Nancy, I have to tell you, Alan made it so simple. I only wish that I would have known this about 100 years ago.
I know. I'm so grateful that he's teaching me all the basics from the start. So we're not done yet. There's so many more questions that we have for Alan, and I'm sure you do too. So if you want to get your question included, email us, thedeepdivingdivas@gmail.com, or write on our wall, Instagram, Facebook, everywhere at Deep Diving Divas. Hope you join us for part 2.
And we'll see you at the bank.
Bye, everybody. Thank you.